Julie, sort of going into year end, where it doesn't seem like you think there's a lot more wood to chop, and also shorter term, it doesn't sound like you think there are major surprises headed our way out of Jackson Hole on Friday.
Yeah, I mean, I'd say the market is taking a breather over the past few weeks. Stocks have done very well this year so far. Not a surprise to see a slight pullback, and August is also a seasonally weak period of time for the market. Jackson Hole is the big focus this week. We want to hear if Powell is more dovish or hawkish tone in his commentary. There isn't a Fed meeting in August, and the next meeting is still a month away. So we think this week's Jackson Hole meeting will be important. And we've come a long way. If you look at the Jackson Hole meeting last year, Powell said the Fed's inflation fight could bring pain. And he was largely talking about job losses, and the market didn't like that phrase. We've seen job losses over the past year, but the unemployment rate is still very low. If you take a step back, we think that most of the market's gains are already in for the year. Our year-end S&P 500 target is 4,500, and that's slight upside from current levels, though it would mean a full year gain of about 14%.
Yeah, 4,500, and then I think your 12-month is not much higher than that, right? 4,700? I just wonder if you think this is going to be a deadly 12 months or if there's going to be wild swings within it.
Well, we acknowledge that the backdrop for stocks is improving. Clearly, the market has already run a lot this year, and we think returns are a bit more muted for the rest of the year. And as you said, in about 12 months from now, our price target, S&P 500, 4,700. And that's largely because we're expecting 9% earnings growth across the market in 2024. And that's compared to no earnings growth this year. So as the earnings growth comes back into the picture, we think the market really starts to price that in. And we see this grind higher in stocks over the next 12 months or so.
Energy, consumer, staples, industrials. It sounds like your sector view is supportive of a pretty benign macro.
Yeah, I think we continue to see an improving environment for stocks and a better risk reward than we had a few months ago. And as you said, we're favoring sectors that haven't participated in the rally as much so far this year. And those are energy, consumer staples, industrials. Energy is only up about 5% so far this year. You've got rising oil prices, improving economic backdrop, and that does bode well for energy stocks. And we also still see opportunities in high quality bonds. It's the time to be locking in higher interest rates. We're probably near the peak of central policy bank rate raises. And so you'll start to see that risk that yields start to come down over the next year. And so where there still is the opportunity to lock in 5 to 10 year rates where they are, we still think there is attractive as well.
Are you finding that clients are still a little bit not receptive to equities because the returns in money markets, for example, are so strong? Or are they interested in hearing what kind of stories there are from an equity standpoint?
I think it's about being selective and thinking about that risk reward and really trying to find the right opportunities in the markets and finding the sectors that have underperformed, like energy, consumer staples, industrials, and really trying to find the opportunities within the market where you can still have some of that upside. And that's really what we're seeing clients thinking about right now.
Interesting. Julie, appreciate that. We'll see what the next few months as we get into year end brings. Julie Fox of UBS.